Hello and welcome back to the American Dream Portfolio. In our first 16 videos, we examined some of the mechanics of building wealth by investing in hard-working assets. Along the way, we've used uplifting words such as appreciation, compound growth, passive income, and financial independence. Viewers could be forgiven if they concluded that building wealth is all peaches and cream. It is not. Before we can begin building the American Dream Portfolio, we must understand the risks inherent in putting hard-earned money into the assets we are considering. And so, our next few videos will consider what those risks are and how we might deal with them. There has been much written and spoken about regarding investment risk. When you drill down to its essence, it comes to this. Investment risk is the likelihood that you will redeem all or part of your portfolio at a loss of purchasing power. In other words, instead of building wealth, you are losing it. One way this can happen is to sell your investment for fewer dollars than you paid at the outset. Accountants call this a realized loss. In other words, you've sold an investment, lost money, and there is no undoing it. Compare that with what is called an unrealized loss. In this case, you've lost money. On paper, your account balance shows a decline in value, but you haven't sold anything yet. An unrealized loss in isolation does not represent a true risk. However, it can prompt the investor to engage in a self-destructive move that will lead to a true and irreversible loss of money, as we shall soon see. Just as there are realized and unrealized losses, there are realized and unrealized gains. If my account balance has increased due to the effects of compounding and appreciation, but I haven't sold anything, then I do not have a true gain. My gain is only on paper. But if I sell such an investment, I lock its true gain, and that money is mine to keep. It can't be taken from me. Except maybe by the taxman, which is the subject of another video. Let's start our discussion of investment risk by exposing an unlikely culprit. Compounding. Compounding itself is not really the culprit. Compounding is a powerful mechanism for growth. The true culprit is our unfortunate misunderstanding of how it works. In previous videos, we discussed how compounding actually works. Compounding means you are paid interest based on the value of your account, and your account value is made up of not only the money you deposited, but on interest you previously earned. The rate at which you are credited with interest may vary. What's important is that you plow that interest back into your account to keep compounding in effect. So where lies the culprit of compounding that creates investment risk? It lies in the common belief that investment growth is primarily, or exclusively, due to compounding. We have already learned that this is false. The primary driver of investment growth is appreciation. The rise of an asset's price over time. Why is this misunderstanding a problem? Let's consider this example. At the first of the year 2022, you began investing in an S&P 500 index fund. Recall that the S&P 500 is our benchmark and, as such, represents a very worthy investment. But you made your decision based on the understanding that this index compounds at an average rate of 10% per year. You don't know much about the stock market, but you did read up on compounding. You concluded, correctly, that an asset that grows only by compounding cannot lose value. How can it? Your initial investment and any money you add can only grow when interest is applied. The account balance can only go up. Compounding does not provide a mechanism for lowering your balance. But as you invested throughout 2022, your account balance became lower than the sum of the deposits you put in. How could this happen if your investment was growing due to compounding? As the year progressed, the results only got worse. You tried to find comfort in the repeated assurances of investment gurus that the S&P 500 compounds at an average rate of 10% per year. Finally, as the end of the year drew near and you were still confronting a paper loss of more than $1,000, you threw in the towel and sold your position. Now you've realized a true loss and there is no clawing that money back. In this example, your investment risk, or the likelihood that you would sell your investment at a loss, was increased by a misunderstanding of how your investment worked. The true and only mechanism by which the S&P 500 increases in value is appreciation. Compounding plays no part in its growth. In fact, compounding plays no part in the growth of any appreciating asset. We were wrong in a previous video when we said the two mechanisms can work hand in hand. They cannot, but we will explain our error in more detail in the next video. Had you understood at the outset that your account growth could derive only because of appreciation, you probably would have realized that appreciation has a reliable but very unwanted dark side. Depreciation. In other words, what goes up must come down. Truer words were never spoken in the realm of investing. In any case, you may have mentally prepared yourself for the possibility that depreciation might rear its ugly head, because it always does. Before we get to the nastiness of depreciation, let's look at a true example of compounding and see how it can only result in the account balance going up. A useful investment available to investors worldwide is the US Treasury bond. As stated in a previous video, these bonds can pay interest for up to 30 years. Let's say you purchased a $1,000 bond paying 4% interest. As long as you hold the bond, the Treasury will pay you interest at an annual rate of 4%. Note that Treasury bonds compound the interest every 6 months, not every year. Recall from a previous video that the compounding mechanism for this bond would provide the following results. Starting value $1,000. At 6 months, $1,020. At 1 year, $1,040.40. At 1.5 years, $1,061.21. At 2 years, $1,082.43. At 30 years, $3,281.03. The point of this exercise is threefold. First, the bond did not appreciate over those 30 years. It retained a fixed value of $1,000. When you redeemed the bond at maturity, you would get your $1,000 back. Second, the interest credited totaled $2,281.03. Compounding played an important role in this amount. Had the interest not compounded, you would have received $20 interest every 6 months, or $40 per year, for the 30 years, bringing your total interest earned to only $1,200, which is just over half of the actual amount. So the only growth mechanism in play here is compounding, not appreciation. Finally, it's important to realize that in this arrangement, there is no way for your account balance to decrease. It can only increase every time interest is applied. However, this is not how stocks, marketable bonds, real estate, or gold behave. And so, investors who believe that their accounts will grow by compounding are fine if they have an investment like a savings account or a government bond that they hold to maturity. But if they carry the vague and hopeful notion that compounding simply means increase in value over time, like 10% annual growth for the S&P 500, then they are confusing compounding with appreciation. This confusion can get them into trouble because, as we said earlier in the video, appreciation has an unwelcome dark side. Depreciation. That is not associated with compounding, and depreciation can cause frightened investors to make unfortunate choices, like selling their investments at an irretrievable loss. In our next video, we will dig more deeply into the fundamental reasons that might cause an investor to sell at a loss. See you then.